The UK offers investors many quality dividend-paying stocks on the London Stock Exchange that are completely tax-free for those of us investing using a stocks and shares ISA. Today I want to discuss my personal favourite dividend growth stock from the UK that also has great capital appreciation and see whether it's a buy at current levels. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. I invest mainly in US-based companies. Here on Trading 212, which is where I've got the majority of my holdings, we see I've got quite a few individual companies that are dividend payers in the US that I'm going to get taxed on. So essentially, we've got the likes of Visa, S&P Global, I believe Murphy's. These all pay a dividend that are in other ways taxed at a higher rate than I would be if I based my investing around UK-based companies. For example, we are taxed at around about 15% before it even gets to us because we hold it in a stocks and shares ISA. And that could be as high as 30% if we didn't have a trade agreement with the likes of the US. So that's something to bear in mind when we think. And that's why I just want to share with you guys my personal favourite company in the UK that pays a growing dividend and not really focused on dividend yield. And that is Games Workshop. This is an amazing brand, essentially, that sells Warhammer products to UK and the US predominantly, all over Europe pretty much. And they are an amazing business because they are in a very niche market with next to no competitors, and they sort of have everything. They have free cash flow growth that is doing very well, revenue growth that is well over 14% now, and they're just doing exceptional for the year. They're currently up 65%. They smashed it on licensing for this year, and they've got new sort of products coming out that are catalysts to drive the stock. And I think this one is doing very well at the moment because it's such an amazing business. One of the main things that's got everyone so excited about this business and is pushing up the share price at the moment is their sort of licensing revenue. So Games Workshop obviously sells and manufactures Warhammer products. These are individual miniature holdings that are built into individual armies that people use to play the game. And this is actually sort of their core business and where they started out. But if we think about it from a more margined perspective, licensing is really where it's at. This is where the business uses its intellectual ownership of its product, the Warhammer lore, etc., and they pass this on, they give it to other providers, and they've recently done so with the likes of Amazon products and stuff like that, where they're using it to make a film/TV series. So there's some really good things happening with this product, and that is pushing up their amount of revenue coming from licensing. So here we have 560 million in core revenue reported, which is no less than 2023 to 2024. That's upwards of about 12% top line growth, which is very good. But we want to focus on their licensing revenue here, which is what everyone's so excited about this year. And they got 50 million in revenue from licensing when it was 31 million last year. That's a 38% increase in overall licensing revenue. And that's something that had a lot of people excited and smashing up the share price. And the next most exciting thing about this business, in my opinion, is their dividend growth. If you are focused on dividend growth as a UK investor, this is an amazing business for you. Now here we have essentially their dividend for 2020, so that's around 5 years ago, and they paid out around about £14.50 essentially, what amounted to around about 4 different payments throughout the year. And they've grown that by 62%. They kept it down low in 2022. They lowered it by about 10 to 20%, and they increased it by 76%, and have kept it at that level for the next 2 years. But in that time, it's gone from £14.50 to £42 overall. Massive increase in the space of about 5 years. So whilst this is not something that is exceptional dividend yield at the moment, sitting around 4.2%, we can see that growth from 1.8% all the way up to 4.2% in the space of about 5 years, which is what is so exciting about dividend growth based companies, and you're getting the full payment. And then we have an amazing catalyst for the likes of Games Workshop and Warhammer, which is their main product. And this is, of course, Henry Cavill, which is a main celebrity over in the US and the UK. And he's heading up the challenge that is basically essentially they've given over the licensing agreement for Warhammer 40k, the lore itself, and they've given that over to Amazon. And Amazon are going to use that to make either a TV show or a film surrounding the Warhammer 40k universe. This is something that's very close to Henry Cavill. He plays the game actively. He's a big advocate for the likes of Games Workshop and, of course, for Warhammer. And that's quite useful because essentially he's going to do this justice, hopefully, and essentially bring more people into this flywheel that Games Workshop has created. Games Workshop is essentially hoping that Warhammer 40k on the screen can drive a bit more growth, maybe make people more involved in the actual product itself, but it also may drive revenue in licensing in the future. If more companies and producers want to get involved in the Warhammer 40k universe, they're going to pay up for that product, and the intellectual property that Games Workshop owns is going to be worth more. Now, there are a few snags with Games Workshop's more recent performance, which has done very well. They've tempered sort of expectations surrounding growth into the future. They've said that this licensing, the revenue that they're currently generating at the moment and have generated for this current financial year is very unlikely to repeat in the next year. So 2026, we're not going to see this 50 million in licensing revenue. It's going to be a lot less than that, and that brought the share price down by a little bit. So there is reason to be cautious in the next financial year with this product, as it may be slightly overvalued now. And just as a side note on what I know of Warhammer 40k and Games Workshop, the product itself is very expensive, and they have maxed out the pricing power, I would say, on what they can affordably continue to incrementally buy. Games Workshop's had a very good run this year because they brought out a new chapter, the Emperors of the Children of the Emperor. And essentially, this is a product that is very good for them to sort of... Everyone buys the new army because they want to fight with it, they want to play with it, etc. But then we get onto stuff like this, which is basically saying that Warhammer 40k is extremely expensive. Every individual sort of miniature costs over £15 or so. And it's actually a bit of a barrier to entry for anyone that wants to get involved in the game. Young children who want to actually get involved in this game are facing problems of actually getting involved and playing the game because it's so expensive to do. You have to buy an entire army to do that or borrow someone else's, and it's quite hard to do in this sort of non-social environment. So as we move games online, I could see this sort of product, Warhammer 40k, start being less played on the tabletop, and hopefully the licensing revenue of Games Workshop can sort of counteract that and continue to do well. But less on a doom and gloom front. This business is still executing very well. This is not a dying business in any regard, and that's what I like about it. Games Workshop has a 3-year CAGR in revenue of about 14%, well above my 10% sort of threshold for revenue growth, and a lot higher than a lot of other businesses. It's shown a level of consistency that a lot of UK-based companies don't in growth of revenue, which I really like to see. Additionally to that, we've got their free cash flow, which is also growing very well, 17% CAGR over the past 3 years, which is the reason that they can increase their dividend growth so much in such a short period of time, those 60 to 70% increases each year that we see. So we see massive jumps when their free cash flow explodes, which it started to. So that's something else to consider with this business. Next, got to ask ourselves, is this a business we should be buying at the current share price of about £160 or so in an overall sort of share price? Well, the reality is it's looking more on the expensive side historically. So currently we have a price to free cash flow of 33, and the sort of average in the past has sat closer to 24. So it is looking on the pricey side, I would say. And 33 times price to free cash flow for a business growing its free cash flow by about 15 to 17% is actually on the very expensive side. It's nearly double in terms of amount of years that I would expect for a PEG ratio. So it's like two times PEG ratio. So that's not great. Price to earnings as well is 30 times compared to the average of around about 22 times. So in the past 10 years, how this business has been valued, this currently looks quite expensive. So now it comes down to using everything we've found out about this business to use it to actually value the business and find a fair share price using free cash flow. So here we try to predict the free cash flows of the business, and we use what we've actually found. So they have a 17% CAGR in free cash flow over the past 3 years. So we could put that in, but that doesn't really show what it's going to likely grow into the future. And I would say around about 13 to 15% would be fair. I'm going to go on the conservative side, as I always do with free cash flow. So 13% free cash flow growth over the next 5 years. We're not diluting any shares. They're not buying back or selling shares. Dividend growth rate about 15%, as they tend to average out at that over the past 5 years. And a price to free cash flow, I would say a more appropriate number for how quickly they're growing their free cash flow is around about 24 times. Now, I know some people may say that that's unfair to the business, that it's earned its premium, and that may be true. Their average over the past sat higher than this, but in my mind, the way they're growing, it doesn't really sort of sit well with me that it's sitting so high. I would like to pay less and average down less in a conservative estimate for free cash flow. With all of that put together, they're actually sitting at quite a fair value of below what they're currently sitting at, of around about 14,948 pence, which is around about £149. Now, I would say this CAGR about 8% is fair. I would say that if you're paying for the dividend growth, then you might not care, but it is looking on the pricier end to me, and I'm not looking to add to this position yet. I would say that their business, despite all of its sort of problems, owns good intellectual ownership of Warhammer 40k, which is a standalone product that is got next to no competitors. But Games Workshop is an older, more mature business. They've stood the test of time. They're a great UK company. They've evidenced that with their dividend growth, and I think it's a great one for dividend growth. But I haven't been able to buy into it yet because I've never really valued it in the correct way, I don't believe. So that's just me. It may be that this fair value is not appropriate to you if you're doing a sort of different analysis. If you say that they're going to sit at that sort of average price to free cash flow that they have sat at the past 5 years, even though they're growing faster, which I wouldn't necessarily agree with, then you're looking at a 10% CAGR. So it could happen, but even then, we're not getting market-beating returns that would rival the likes of the S&P 500. So I would prefer to be conservative with this estimate, and at the moment I don't believe that this is the best share price to pay for Games Workshop. But what do you guys think? Do you like this business? I certainly do, and let me know down below if you might own it. Thanks for watching, and I'll catch you in the next one.